emerging markets in particular that are going to benefit dramatically from the declining dollar, because a lot of their debts are in dollars, and basically their debts get wiped out as the dollar declines, and that is rocket fuel for their economies. So these emerging markets are going to boom. Investments that are linked to commodities are going to do extremely well. You need to own physical gold as a safe haven, as a store of value. Don't get conned into Bitcoin. Bitcoin is a bubble. Bitcoin isn't a safe haven. It's not a store of value. You can't store what you don't have. When you own gold, what you're doing is storing the future use of gold as a metal. People need gold. They'll always need gold. Jewelers need gold. Computer chip manufacturers, the aerospace industry, dentistry. Gold is the most useful, the most valuable metal on the planet, and it doesn't decay. But gold is to preserve your wealth. You're not going to get rich owning physical gold. You'll avoid going broke. But if you really want to get rich or, get a lot richer, gold stocks, I believe, have enormous potential. I think some of these stocks can go up 10 times, 20 times, 50 times. So I think a lot of money is going to be made in gold stocks. Of course, there's a lot more risk in gold stocks. I mean, no pain, no gain, right? You can't get big returns unless you're willing to take big risks. But I think the upside potential is enormous compared to the downside risk. So if you are a risk taker, I think these risks make a lot of sense. Now, of course, a lot of the inflation that government has been creating since the 2008 financial crisis, a lot of that inflation has temporarily moved into asset pricing. That's the stock market, the bond market, the real estate market, the market for collectibles, other things that are, in short supply. And so when inflation pushes up asset prices, people don't complain because the people that own those assets, of course, feel much richer. Now, if you don't own those assets, obviously it's problematic if you want to buy it. For example, if housing prices keep going up and you don't own a house and you want to buy one, the fact that prices keep going up, that's not a good thing. Now, the way the government has offset that is by keeping interest rates artificially low so that people can afford to overpay for houses as the prices keep going up. But again, all of that helps distort the economy and fuel the bubble. But beneath the surface, consumer prices have been rising. The last thing the government wants is for the public to realize how much inflation there is. They certainly don't want bond investors to realize that. The key to sustaining the bubble economy, the key to sustaining massive and unsustainable government deficits in the short run is artificially low interest rates. And the Fed's only justification for keeping interest rates artificially low is the preposterous idea that there's not enough inflation. So this is all a ruse because the government is trying to justify a reckless monetary policy that is designed to protect the government, not the economy or not the people. But we're about to suffer the consequences of all this inflation in a way that's far greater than what I even imagined. And a lot of that, too, has to do with what's happened during the pandemic, which is obviously not an event that I had built into my forecast, but nonetheless is simply accelerating everything that I have been forecasting and will make it worse. Because a lot of people, their initial response to the pandemic was, oh, this is deflationary, right? This means people are not going to have demand for things because they're staying at home. Well, that's true. A lot of people stayed at home, and so they didn't buy as much, airline tickets or stay in hotels, but they had no problem shopping on Amazon. And so it wasn't that demand stopped during the pandemic. It just transferred money that consumers weren't spending traveling. They simply spent it on other things. Government produces nothing. Government lives off the productivity of the private sector. Well, if the private sector is thriving, then the government can take some of those resources. But when the private sector is struggling with pressures like the pandemic, government needs to be smaller. Government needs to cut back and free up those resources back to the private sector so it can use them when it needs them. Instead, we did the opposite. We compounded the problems by increasing the toll exacted by government. And so we have more debt than ever before, more money creation than ever before, and we have created an economy that is more dependent on debt and money printing than ever before. That is why inflation is about to go through the roof. And think about it as a tax. The government is about to take most of what you have, not through taxation. Now, they're going to increase taxes. There's no question that the Biden administration is going to raise taxes. And if you think otherwise, you're delusional. But the main tax that is going to hit everybody is going to be inflation, especially if you're poor or middle class and you're working and all you have is your wages, and those wages are going to be dramatically diminished in value because of inflation. But probably more important to this audience, if you are a saver, if you are retired, or if you are nearing retirement, you are about to be decimated. Your entire life's savings is about to be taxed away by inflation. The dollar is going to be destroyed. That's why the US dollar is already falling, despite the fact that all the experts predicted it would rise, and now it's poised for a much bigger loss. So what do you do? How do you invest in the era of inflation? Well, go back to the first decade of this century, and that will give you a playbook. You can also go back to the 1970s and see what performed well during that decade. But what we're about to experience is going to be so much worse. But if you go back to that time period, just go back to 2000 and 2010 decade, and that's when the Fed was printing all the money to kind of stimulate the economy after the dot-com bubble burst, and what they did to try to push up housing prices, and then how they reacted immediately to the bursting of the housing bubble. What did well? The dollar fell dramatically from 2000 to 2010. Dollar index was about 120, and it went down to about 70. Oil prices went from about $20 a barrel to 150. Gold went from under 300 to 1900. Silver went from $4 an ounce to $50 an ounce. Emerging markets just killed it. They were up 400 or 500%, while the U.S. stock market went down. First decade of this century, the S&P went down in value. And of course, the real value of U.S. stocks was down even more if you measured them in foreign currencies or if you measured them in the price of gold. Well, the dollar is going to be a lot weaker now than it was then. I think metal prices, gold prices, other commodity prices are going to be much stronger in this decade than they were then. And so I think the relative gains that investors will enjoy by investing in overseas markets will be even greater than the big gains that they enjoyed in the first decade of this century. And if you go back to the 1970s, what were the good investments of the 1970s when we had stagflation? This time it's going to be worse stagnation and worse inflation. What happened? The Deutschmark tripled, the yen tripled, the Swiss franc tripled. Gold went from $35 an ounce to $850. Oil went from $3 a barrel to $30 a barrel. I mean, it was huge increases in commodity prices as the dollar collapsed. The only reason the dollar stopped falling in 1980 was because we had Ronald Reagan coming in and we had Paul Volcker allowing short-term interest rates to rise to 20%. That's how broke we are today compared to 1980. 1980, we were still the world's biggest creditor nation. Now we're the world's biggest debtor. Back in 1980, we still had trade surpluses. Now we have massive trade deficits. So this is going to be a massive change. I think the dollar is going to not just decline, but collapse. I think the next crisis is not just a financial crisis, but a dollar crisis. And so the most important thing that you could do now is to completely divest of U.S. dollar assets. You got to get out of U.S. bonds in particular. Bondholders are going to be the biggest losers as the dollar collapses because all bonds are promises to be paid dollars in the future. And as little as dollars buy now, they're going to buy a lot less in the future. U.S. stocks are way overpriced and their earnings are predominantly in dollars. Sure, you have multinationals that are earning foreign currencies, but a lot of their earnings come from the U.S. and those earnings are going to decline and are going to be worth less. But of course, taxes are going up. So whatever American companies end up earning, there'll be less of it available for their American shareholders because of high corporate taxes. The Federal Reserve has been promising Americans more inflation. Well, that's one promise that they're going to deliver on. In fact, they're going to deliver on it beyond their wildest expectations. And contrary to what everybody is saying, inflation is not a good thing. Inflation is not desirable. Higher inflation is not making progress. What people want is a lower cost of living. When prices go down, that's progress. And that's capitalism. That's how capitalism works. When you have real capitalism, businesses become more productive. They become more efficient. They develop economies of scale. And as they do that, the cost of production comes down. And as the cost of production goes down, demand goes up. Because as prices go down, more people can afford to buy more stuff. And it's falling prices that have historically driven a rising standard of living. Well, the government has interrupted that benevolent process through inflation. And a lot of the times, inflation doesn't simply make prices go up. Inflation also prevents prices from going down. And a decline in a price would have been a windfall for the consumer. When the consumer is denied that windfall by government, it's still a tax. The government is still taking your purchasing power because the goods and services that you want to consume are more expensive as a result of the government inflation.